friends, welcome back to Random Glean. It's been a minute, Chris. So I'm glad to be back, and on account of it having been a little bit, we've got a lot of charts to cover today.
A ton.
We've got a ton. So please do watch to the end, because I guarantee you, all 16 of these slides are worth the price of admission. Go ahead and hit subscribe and share it with a friend, because this is a good conversation. Chris, we're going to cover. We've been in a period of kind of animal spirits,
it's
right?
A party.
Animal spirits, and yet there's then we go into a little bit of there's going to be some conflict with these animal spirits.
So let's start with the party, okay? So I mean, markets are up, and markets are above their 200-day moving average, which means they're trending upward, kind of overbought, and that's fine. Our friends at Fundstrat say, hey, look, going back to 1970. More than 2/3 of the time, the S&P is up another 20% from there, which, hey, that sounds great, right?
It does. And in this next chart, you would suggest that active money managers are saying, hey, I'm getting in the party. They were kind of holding out for earlier in the year, and now they're joining the party, and they are all but fully exposed to equity.
So let's look at this chart from our friends at Bespoke. For just the sixth time, this is from last night, sixth time since post-World War II, that's a little less than once a decade, the Dow has rallied for 11 or more straight days. And that usually means good things. It's exciting.
It certainly means that people are buying, and then
but it's also expanding too. So next chart, if you look at the percentage of new 52-week highs, that's expanding, which means it's not just 7 stocks.
Yeah, we were talking a lot about that earlier in the year, and that was the case. But now we're seeing that across the broader market, other companies are starting to participate.
Which is good.
Oh, absolutely.
That's
it's a good
what
thing.
You want.
Yep.
And in fact, if you look at the chart of the 4-year presidential cycle, what you see is we've started to turn more upward, like you would expect to see in that third year, which of the 4 years of the presidential cycle is consistently the best performing year. And that's nice to see.
But it's earnings season.
But hang on.
So let's take a quick review of where we've been and where we are right now from an earnings perspective.
Yeah. So it hit me this morning. Last year, this time was the highest number we had seen in terms of earnings per share on the S&P 500, and we hit $55, $56 a share, which implies on an annualized basis $220, right?
$220.
Yeah. So, I mean, we've kind of worked on that $220 baseline threshold for a while now. So this is Q2 of 2023 we're looking at now, effectively the same time. Let's take a look at where we are. We're looking currently at consensus around $51 and change, right? Well, if that's the number we get,
right,
that's 9% down.
Correct. Year
over year.
That's right.
Okay.
And it puts the annual earnings at just over $200 a share.
Right. Which, again, that's not going to be the final number.
Right.
Because the back half of the year, the numbers are usually a little bit better. But Q2 of 22 was the high point.
Correct.
So effectively now we're in this period of, okay, well, we're coming out and earnings are going to go up. So let's look at a tweet actually from Bob Elliott from this morning. So Bob Elliott used to be on Ray Dalio's personal asset management team from Bridgewater. Dalio is one of the top 10 richest people in the United States. So
all off investing kind of genius. So for those of you who are not familiar.
Right. So this is a tweet from this morning. I think hands down, this is probably the best tweet thread I have seen in 2023.
Oh, for sure.
So Bob says, what's the likelihood 2024 is going to have a 12% earnings growth? Like everything's going to get better from here. Right. And we get 5 rate cuts, which is what this chart says below, basically starting in March of 2024.
We show this chart very regularly, and so he's expanded the window all the way to the end of next year. And as you can see, the probabilities are that by the end of 2024, there will have been 5 rate cuts.
So what he's saying is, next chart, the earnings picture is, hey, we're going to get 12% earnings growth, and yet we're going to get 5% interest rate cuts. That's like saying you're going to get it both ways.
That's right. That is what is being priced in right now.
That's a tall order.
That is a tall order.
So if we finish at this number at the bottom of the page for calendar year 2023, which is 218.58, and we're trading at 45.60, That implies we're trading on the higher side of 20 times earnings right now, 20 to 21 times earnings, okay? The median earnings multiple for the last 20 years is 16.2 times earnings.
Right.
Which at 218 implies about a 3,600. Now, I'm not saying that's what it's going to do. I'm not saying that at all. I'm just saying we ain't cheap here. Okay?
Well, I mean, Bob goes on to suggest that the scenario in which rates would be cut are not supported by earnings going up 12%.
Right. Yeah, earnings going up 12% does not imply a Fed comes in and cuts. In fact, it would imply earnings are going to fall.
That's exactly right.
Which is also, incidentally, what the yield curve has been telling you now. The 10s, 90s, right. The 10s versus the 3-month T-bill have been inverted since last October.
That's right.
Okay? There's no change there. The yield curve is still saying we're going to have a recession, okay? I mean, if you have 12% earnings growth, and this is the next point Bob makes, okay, take the continued strong nominal growth scenario. Earnings growth could get close to what's priced in, but in that scenario, it's unlikely the Fed shifts to easing in line with what's priced in. And in this case, in fact, if the Fed gets ahead of the economy, rates will rise, and that will put a downward pressure on multiples, limiting equity returns. Okay, so what's that mean? It gets back to the notion of the multiple, right? Where are we trading?
Right.
Okay, so right now, what's interesting is that if you look at the last 20 years, there have only been 2 years in which Fed funds has traded above 5%.
Right.
They are right now in 2007. That's 10% of the last 20 years. And yet we're trading not at the median multiple, 16.2 times earnings. We're trading at almost 21 times
or
earnings.
not below, given where rates have been over that 20-year period, right? So, yeah, that's exactly right. We are trading well above the median, which is not supported based on historical norms of a rate being this high.
The point Bob's getting at is you can't have it both ways.
That's just it.
I mean, it's you're either going to have continued issues with respect to rates, which implies multiples have to come down, or at least historically that's the way it's worked.
Slow down, right?
Right.
Settle.
Or in fact, earnings don't do that. Margin pressures are there, and stocks roll over some of that. I know. Look, I don't know what's going to be.
That's right.
I really don't. And obviously, the animal spirits are there. Okay, they're there. The question is, can they continue? But meanwhile, next chart.
Yeah, so this is a look at the earnings yield versus the 3-year Treasury bill, and what you can see is it implies there is an alternative to owning stocks right now.
There absolutely is. For the first time in 22 years, you've actually got a better return versus the earnings yield from 3-month Treasuries.
That's right, and that's paying about 5.3 right now. That's probably going to go up just a bit tomorrow, or this week.
If the Fed raises,
if the Fed raises 25, which is
expected.
very much expected. That's
Yeah.
right. So.
Okay. So let's talk about what happens with inflation from here as well. The line that catches my eye probably more than any is the blue line in all the scenarios on the right-hand side.
Ahead of today, that's right.
Right, that's right. So if inflation rises 0.2% a month over the next 4 months, then basically headline inflation goes back to 4%. And the Fed wants 2%.
Yeah. Well, so I looked at it the same way. What does this imply based on the scenarios that they've looked forward on? And what I gather is you need a 0.2 month over month increase or less to get to 0.2 by a year from now, right?
Okay.
And so anything above that pushes us above 12 months out when everyone's convinced that everything's now taken care of from an inflation standpoint.
So riddle me this. Can you tell me how much orange juice is up in the last 30 days? Orange juice futures.
I don't know.
15%. Can you tell me how much oil is up in the last 30 days?
I know. So I did a little road trip, and I know I left, and it was, I think, 289 filling the tank before I left, and I think it's 320 something now at the gas pump.
So here's a chart of crude oil over the last 30 days. Crude oil is up 13.7% as of this recording on the 25th at 12:15 noon. Okay, so listen, inflation's not dead, people, and anyone that goes to the grocery store would tell you that.
Well, it's like what we've talked about a lot. The denominator of inflation, the heavy part of that is now behind us, and now we're looking forward again with softer numbers from last year. And things like this are happening.
The only way inflation is going to die is if you get a slowdown in the economy, which is a fundamental change to the consumer and a fundamental change to corporate America. Maybe not. Maybe corporate America doesn't. Maybe they just lay off and they figure it out. But that would, begin to right size things. We showed this chart before, but I mean, median consumer CPI. I mean, we're still running hot relative to where the Fed is targeting, and there's no two ways about it. In fact, I saw this over the weekend, and I included it. New York renters faced highest rent increases in a decade. Look, y'all,
Well, I think the difficult part is the pictured couple there is not someone that you expect is probably still making, earning an increased living. And so that's where it comes down to, is if you're living on a fixed budget at this point because of what you've saved, these increases are going to be painful.
You don't get it both ways. That's what it boils down to.
That's right.
And I mean, again, finally, cash is paying.
Yeah.
If you've got it in the bank, it's not earning you enough. I'm telling you, I mean, you can get yields at 5.3, 5.4% right now from 3-month treasuries. It's not hard to do. Talk to us,
Right.
please. You got anything else?
I got nothing.
Hey, we hope you made it to the end. Tons of great charts, more to come in future weeks. Thanks as always for watching. Please do hit the subscribe button. Click the bell in order to be notified when we do post. Thanks as always. See you soon.